This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, welcome back to my channel. When we evaluate S&P 500 covered call products, TappAlpha's TSPY stands out as a significant competitor to popular funds like SPYI. For many income-focused investors, the primary struggle is how to generate high monthly yield without sacrificing the capital appreciation of the underlying index. Today, we will examine the performance data from the 2025 bull market to understand how TSPY's specific mechanics and fintech-driven models differentiate it from its peers. So let's begin today's video. Looking at the total return results for the full year of 2025, the pure S&P 500 index represented by VOO returned 18.12%. TSPY performed impressively by delivering a total return of 17.86%. During the same period, SPYI achieved 16.81%, while the US dollar version of Evolve's ESPX reached 12.53%. It is notable that during an 18% market surge, TSPY trailed the benchmark by only 0.26%. This indicates an exceptional level of efficiency in capturing market upside while simultaneously providing monthly distributions. This performance gap suggests that TSPY's strategy is fundamentally different from traditional covered call funds, which often trail the index by 5% or more in a bull market. To verify this efficiency over a longer term, we can look at the cumulative data since TSPY's inception on August 15, 2024 through January 15, 2026. Over this 1.42-year period, TSPY delivered a massive total return of 26.27% with dividends reinvested, which is remarkably close to VOO's 27.56%. Even without reinvesting dividends, TSPY still achieved a 23.75% total return, while VOO reached 27.28%. This inception data confirms that TSPY can effectively convert market volatility into income while capturing nearly all of the index growth. Before we dive deeper into the covered call strategy, let's look at the baseline data for TSPY as of January 13, 2026. Regarding its size and liquidity, the net assets have already approached $192 million. The current market price is around $25.63, which shows an extremely low premium because the NAV is sitting at $25.61. When it comes to the cost of ownership, the management fee is 0.68% and the total expense ratio is 0.77%. For an actively managed derivative ETF, this cost structure is considered very disciplined. In terms of cash flow, the distribution rate is impressively high at 14.2%. Furthermore, it is important to note that TSPY's distribution is relatively consistent and the monthly variation is quite small, which provides a reliable and steady income stream for investors. The core success of TSPY is rooted in its actively managed zero DTE strategy. According to the prospectus, the fund maintains a long position in SPY to track the performance of the S&P 500 index. To generate income, the advisor sells out-of-the-money call options that are typically between 0% and 5% above the current market price. These options are usually zero DTE, but the fund has the flexibility to use expirations from the same day up to 1 week. The fund can write these options on SPY, the S&P 500 index itself, or even XSP mini options. Now let's perform a comparative calculation to estimate the coverage ratio, which is not explicitly disclosed in official documents. We can use Roundhill's XDTE as our benchmark because its prospectus confirms it uses a synthetic strategy with 100% coverage of its notional value. XDTE provides an annual yield of approximately 38% by selling call options against its entire portfolio every day. If we take XDTE's 38% yield and divide it by TSPY's 14% yield, we get a ratio of roughly 2.7. If we then divide XDTE's 100% coverage by this ratio, we arrive at an estimated coverage for TSPY of approximately 37%. While this 37% figure is only an estimate, it is clear that the fund only covers a small portion of its portfolio. This lightweight coverage is only part of the story, as the fund's high efficiency also relies heavily on its automated fintech model for precise strike selection. This stands in stark contrast to the Canadian market, where many low-coverage funds must rely on 25% leverage just to match the performance of the underlying index. TSPY achieves this through zero DTE execution efficiency alone, without the need for additional leverage. Interestingly, the fund can also take defensive actions such as purchasing put options or using multi-leg credit spreads during periods of heightened volatility. In conclusion, this specific design makes TSPY a hybrid powerhouse that balances high yield and index tracking while capturing nearly 95% of the total return since inception. The success of TSPY led to the introduction of TDAQ, which applies the exact same zero DTE mechanics and fintech-driven selection process to the Nasdaq 100 index. Just like TSPY, TDAQ is designed to participate closely in the capital performance of its underlying index while generating high monthly income. Building on these core strategies, the firm recently launched TSYX and TDAX, which are 30% leveraged versions of the original funds. It is vital to understand the structural difference compared to the Canadian market. In Canada, many leveraged ETFs use a static cash leverage of around 25%. However, the leverage for TSYX and TDAX resets daily, which introduces the risk of volatility drag. For example, if an index starts at 100 points and drops 10% on day 1, it hits 90 points. The 1.3 times leveraged version would drop 13% and end at 87. If the index rallies back to 100 on day 2, which requires an 11.11% gain, the leveraged version only gains 1.3 times that amount, bringing its final value to 99.56. Beyond this erosion, we must also consider the cost of borrowing. Leverage is not free, and these funds must pay financing costs to maintain their 1.3 times exposure. In a higher interest rate environment, these borrowing costs further weigh on the fund's performance. In my view, while these leveraged versions offer higher yield potential, the combination of daily reset drag and borrowing costs makes them a double-edged sword. They are tactical tools that require a clear market trend to succeed, whereas the core TSPY and TDAQ funds are much more robust choices for long-term income seekers. In summary, TSPY provides a sophisticated tool for converting index volatility into cash flow with minimal impact on capital growth. As we have seen, it maintains high efficiency through its fintech model. Because TSPY and TDAQ are listed in the United States, Canadian investors must be mindful of the tax implications. For many, it is best to hold these assets within an RRSP account to optimize tax efficiency and avoid the 15% foreign withholding tax on distributions. Some of you may remember that I recently cleared my position in HYLD. For a long time, I struggled with what to buy next to replace that income stream. Ultimately, I decided to buy into SCHD, ESPX, and CDA. However, if TSPY were available in the Canadian market, I would have bought into it without any hesitation. Since Canada currently lacks index-covered call ETFs with this level of zero DTE efficiency, I truly hope that TappAlpha will eventually launch Canadian versions of TSPY and TDAQ. If that day comes, I will definitely be the first to lead the way and buy in. If you enjoyed this content, please like, subscribe, and leave a comment. I am Oldfish, and I will see you in the next one.